Hello, I'm Sami Zaidan. This is Counting the Cost on Al Jazeera, your look at the world of business and economics. Hovering at $100 a barrel, oil prices were expected to soar even further. Yet, more than 100 days into the Iran conflict, they haven't. Has the world absorbed the energy shock, or is the worst still to come? The impact is far from equal. The UN says vulnerable economies could see oil import costs rise $20 billion a year. Can they afford to protect businesses and households? And where will the money come from? More than 100 days into the Iran conflict, 20% of the world's energy flows disrupted, described as the biggest supply shock in history. Well, for now, the nightmare scenario has been avoided. Oil prices still hover around $100 a barrel. Many analysts are warning a prolonged disruption to the Strait of Hormuz, though, could send oil above $200 a barrel and trigger a global economic crisis. But instead, governments released strategic reserves, exporters found alternative routes, and weaker demand helped to contain those prices. But the buffers are thinning. The OECD warns the economic impact could linger well into 2027, even if the conflict ends tomorrow. So has the world proved more resilient than expected, or are governments simply postponing the economic pain? Fintan Monahan reports.
When the US and Israel launched their war on Iran, the world held its breath as the global economy hung in the balance. Iran quickly moved to disrupt shipping through the Strait of Hormuz, a choke point for 20% of the world's oil and gas flows. Prices soared, and the Iranian military warned the US that they'd rise even further if the war dragged on.
If the war spreads across the region, expect oil to reach $200 per barrel. Oil prices follow the level of security in the region, and the source of that insecurity is you.
Many analysts feared the worst, but this didn't end up happening. Oil prices shot up when the war broke out, with the daily average of Brent crude peaking at just over $114 a barrel. But they've since settled down, dropping back below the $100 mark. Much higher than before the war started, but a lot lower than many expected.
We have everything we need. The world doesn't. But I will say, people thought it was going to be a lot worse. You know, today I looked at $96 a barrel. People thought that was going to be $300 a barrel.
The US is the world's largest oil producer. It had been ramping up production even before the crisis began. Since the war broke out, it's been able to export an extra 2 million barrels of oil a day. Many countries that used to get their oil from the Gulf have turned to America, and the increase in supply has helped calm the market. Nations belonging to the International Energy Agency also agreed to tap their strategic reserves after the war began. Around 400 million barrels were released, further easing pressure on oil prices. At the same time, China has cut its oil imports. Before the crisis, it was taking in 11 million barrels per day. Now, industry experts say it's only importing around 6.5 million, choosing instead to rely on its reserves. Other smaller-scale measures have also helped ease the pressure. Some ships are finding ways to make it through the Strait of Hormuz. And the US has granted sanctions waivers on Russian oil, making it more freely available on the open market. But the danger is far from over. Nations have been eating into their reserves since the war began, and eventually these will begin to run dry. Even the United States has had to tap into its stockpiles in order to ramp up exports. And while China has reduced its imports, it may be a matter of time before this begins to rise again. The global energy shock has rocked the world economy, but major actions by global players have granted a reprieve from the worst-case scenarios. But if a lasting solution can't be found to the blockade at the Strait of Hormuz, it may prove impossible to hold back the rise in the price of oil. Fintan Monahan, Al Jazeera, for Counting the Cost.
Well, the price of oil might not have hit $200 a barrel, but it has still gone up. People around the world, they're feeling the effects. The OECD warns a prolonged disruption at Hormuz would reduce global economic growth to 2.1% this year and just 1.8% next year. Central banks would also be forced to increase interest rates in order to control inflation. Prices at the pump, they've been rising nearly everywhere, fueling inflation. In the European Union, for example, petrol is up around 14% on average since the war began. Out of 75 least developed countries in the world, 65 depend on imported oil. As oil prices have gone up, they're having to make difficult trade-offs between covering fuel bills and funding essential public services. Around 1 billion people live in these countries, and nearly a third of them are below the extreme poverty line. Well, that means they live on just $3 a day. So, if oil prices keep rising, it could have catastrophic effects on some of the world's most vulnerable people. Well, for more on this, let's bring our guests into the show. We have joining us from Paris, Neil Atkinson. He's a visiting fellow at the National Center for Energy Analytics in Washington, D.C., and the former head of Oil Industry and Market Division at the IEA. In London, David Lubin, he's a senior research fellow at the Global Economy and Finance Program at Chatham House. And in New Delhi, Jayati Ghosh, she's an economist and professor of economics at the University of Massachusetts. A very warm welcome to everyone. Now, to kick things off, what I'm going to ask everyone to do, and we can start perhaps with Jayati, but first of all, each of you, in no more than 10 seconds, can you tell us what has been the biggest single surprise of this economic crisis triggered by the war?
I think the biggest surprise for many people has been the extent of interdependence, not just in terms of oil and gas, and obviously fertilizer, but the range of byproducts such as helium, phosphate, sulfur, etc., that are impacting production, but also impacting the lives and livelihoods of formal and informal workers.
All right, David, in 10 seconds.
I think the biggest surprise is that the war began at all in the first place, because the economic consequences of it were so glaringly obvious that this was an existential threat to the government of Iran, that the Strait of Hormuz would be closed, which was something that had been understood by the US administration fairly clearly, I think, and that the stagflationary shock for the global economy that was playing out as we speak was really quite likely.
And Neil, what's been the biggest surprise from this whole crisis, do you think?
The biggest surprise so far has been that since the crisis began more than 100 days ago, that oil prices have not escalated to much higher levels than they actually are.
Okay, now let me pick up with David and ask this. If the measures which I mentioned at the beginning of the show, things like China cutting its oil imports, some of the relief of sanctions on Russian oil, the US ramping up production, many economies opening up their inventories. If some of that has worked to some extent in not taking oil prices as high as some had predicted, I guess the question, David, is for how long? Is the timeline here infinite for how long we can hold off?
Well, it's worth bearing in mind that the average price of Brent in 2025 was $69 a barrel. And so however low oil prices seem at the moment, they're still substantially higher than they were in 2025. And that means that the inflationary shock will remain a serious threat to overall to kind of financial stability in the world. The biggest risk is that the United States incoming Federal Reserve Chairman, Kevin Warsh, will need to hike interest rates. The market is currently pricing something like a 70% chance that the US Fed will need to hike rates later this year. And given how delicate the structure of global asset prices is, given the amount of optimism that's embedded in the S&P, for example, in credit spreads, the risk of a rate hike in the United States is very substantial because it could derail the structure of asset prices, and that could be very damaging.
Very damaging on the horizon. Neil, at what price point does domestic pressure in the US, from things like the pump prices, the summer driving season, dwindling reserves, at what point does that force Washington to start to have to choose between, does it want to supply the world? Does it want to protect American consumers and have to change some of the export policies?
Well, we're already seeing in the United States pump prices, certainly as far as the national average is concerned, rising around $4 a gallon, and substantially higher in certain parts of the country, including California. What we'll start to see as the holiday season kicks in, particularly after the Independence Day holiday on July the 4th, is whether discretionary driving is actually going to be hit. So far in the United States, there has not yet been a particularly dramatic impact. But politically, as we all know, the gasoline price in the US is very, very sensitive. And it may well be that once we start heading through possibly $5 a gallon or more as a national average, then there will be pressure to find some sort of solution to the Middle East war. But at the moment, there is no sign of a solution to the Middle East war.
So what is the timeline for that pressure, do you think, Neil?
Well, I suspect we still have several weeks to go. And, you know, something I've learned in more than 40 years of analyzing oil markets is that you should not put a date and a time on your forecast. And the reason for that is simply we do not know. And the reason we do not know in these circumstances is that this is an entirely new situation. We have never been here before, and it's playing out so far in very different ways than we expected when the crisis started on February the 28th. We have not yet hit a cliff edge, and we have not yet been in a situation where the figure of $200 a barrel for oil prices, which frankly is educated guesswork, is even remotely in sight.
All right, playing out in different ways, Jayati, different ways for different parts of the world. Even if the price per barrel hasn't reached $200, it's still high. What has that meant for the global South countries?
First of all, let's remember that it's not gone up as much also because massive amounts of strategic reserves have been released. The IEA estimates, I think, more than 400 million barrels or something so far. And many countries are also releasing their own strategic reserves. And that has kept the, reasonably stable within around $100 a barrel crude. But the impact already in all kinds of different ways is massive. I can talk about South Asia and Sub-Saharan Africa, where, as I think you already mentioned, these are some of the poorest people in the world also reside in these areas. And natural gas, which South Asia and Sub-Saharan Africa import heavily from the Gulf countries. Already, the price of certain types of natural gas has massively impacted the possibilities of just cooking gas being available to people, the prices of which have skyrocketed. In India, they have cut the commercial access to cooking gas, which also impacts small traders, people who cook on the streets, the street food vendors and so on, which really means actually millions of people have lost their livelihood already. We're not even talking about the crisis having fully hit yet.
I don't know if I want to ask you, Jayati, what will it mean if we do hit $200 a barrel? Briefly.
It's everything. It's oil, it's fertilizers, it's phosphates, it's sulfur, it's helium. All of these things are going to impact agricultural production, other kinds of production, even the sort of, blazing new signs of the new economy, the IT sector and the semiconductors and all of that. Everything is actually impacted.
Well, the US is
My concern is that the US economy doesn't get as badly affected. And ultimately, US leadership and US people don't care that much about the rest of the world.
Well, talking about the US, Jayati, the US has been pumping out oil to meet global demand, but it's doing that at the cost of its stockpiles. Take a look at this graph, for example. The US oil inventories, well, they haven't been this low since 2003. There's still around 100 million barrels, but America is drawing from this in order to ramp up exports. Neil, briefly, how much of a timeline do we have before those inventories start to run dry? Do you think we can see $200 a barrel?
Well, that graph, I think, is not including all the extent of stocks in the United States. And it certainly doesn't include the levels of stocks that we're seeing in other parts of the world. What we need to bear in mind is that, yes, it's right, it's accurate that the IEA led a coordinated stock release of over 400 million barrels. But the point about that is it doesn't all arrive overnight. and it's oil that is offered to the market. It isn't force-fed to the market. The market doesn't have to take it.
Right.
And what we have seen is a gradual release of coordinated stocks of about 2 million barrels a day, which is important, it's significant, and it's made a contribution to offset the impact of the Strait of Hormuz. But there is a point below which the strategic stocks will fall below operational levels, not to zero because they can't, but below operational levels. And at that point, there will be stress in the market unless the impact of rising prices, which might start to rise, starts to hammer demand destruction. So that is a factor that we must consider.
I want to run us through another point, and that is that US job numbers were up 172,000 in May. And the US President Donald Trump was saying, hey, it's a good sign for the economy, despite the hike in oil and gas prices. Now, he's calling on the Federal Reserve to lower interest rates.
You know, if you go back 15 or 20 years, when you had good reports, the market went up. Nowadays, when you have good reports, the market goes down because they think they're going to raise interest rates. There's no reason to raise interest rates. The country becomes great. We built the country by doing great and having rates low. What they do is when they raise interest rates, they try and kill success. I don't want to kill success. We should actually lower interest rates.
Well, even though the US is relatively insulated from the energy crisis, people there are still feeling the effects. Households, for example, they've been forced to spend $750 more in basic necessities since the war started. Most of the extra spending is on energy-related expenses. Petrol prices are up 40%. Before the war, they were around $2.98 a gallon. Now, you're looking at $4.22. Energy costs have jumped 5.5%, which is a key indicator for inflation. Overall, prices were up 3.8% in April compared to the previous year, the biggest increase in 3 years. So, David, when we look at what's happening in the US and you compare it to Europe, well, the ECB, European Central Bank, widely expected to actually raise interest rates this week, David. Is their cautiousness about inflation justified, or is Donald Trump right that, raising rates into an energy shock is the wrong medicine?
You can't cut the oil price by raising interest rates. So central banks would be wrong just to kind of raise interest rates in the face of a pure inflation increase just driven by the oil price. What central banks have to worry about, though, is what economists call second round effects. In other words, the idea that the increase in oil price feeds through into the setting of wages and prices. And that is a really serious threat. We've already seen the Reserve Bank of Australia, the Central Bank of Indonesia, the Central Bank of South Africa all raise interest rates, as you mentioned. The ECB, the Bank of Japan are very likely to raise interest rates during the month of June. And the big question, as I said earlier, is whether the United States, the Federal Reserve, is going to have to raise rates later this year. The market is increasingly anxious that that will be the case. Donald Trump is crazy to argue that interest rates should fall. Inflation expectations in the United States have risen quite sharply since the war began. And so the chances of a rate hike in the United States are really quite material now.
Jayati, what options do central banks in developing countries have as all of this inflationary pressure, it's pushing up bond yields, which means the dollar strengthening, borrowing costs, dollar borrowing costs are going up. How are central banks in developing countries managing with this?
Well, you see, this is the trouble. It's really always not just a double, but a triple whammy for most developing countries. Because it's not just that you are faced with rising import costs. Our exports, a lot of our countries relied quite heavily on exports to the Gulf region. Those have come down dramatically. And there's capital flight already out of our regions. And that means you really have to raise interest rates to preserve or prevent your currency from devaluing too much. So it's a multiple whammy in that sense. So Indonesia, for example, Indonesia's interest rate rise is because of the fear of capital flight. And if India does it also, it will be because of that fear. It's
Any
not, I
signs
mean,
of
it's not really about inflation control, because in India, it's driven by the cost price increase. It's not wages at all.
any sign of a sovereign debt crisis that we should be worried about, Jayati? Briefly.
Yeah, well, I mean, look, there are many countries in quite severe debt crisis already, and they affect very large, I would say about 300 million, 400 million people across the world are affected quite dramatically by living in countries with very serious debt stress. As long as it's not seen as, shall we say, a systemically important for the global economy, then unfortunately, global finance and the US are not going to bother with it.
All right,
It's
Neil.
really only when these are seen as central to systemically important that it's going to matter.
Let me take it to Neil in Paris now. Europe and Asia, they've deployed a range of responses to the crisis, right? From inventory releases, supply diversification, price controls, looking for alternative supply routes. Is there a model you can look at, Neil, and say that's emerging as the right model or the better model of how to handle this crisis? Or is it a case of there isn't a one-size-fits-all? It really depends on your geography, your pre-existing infrastructure, and so on.
Well, there isn't a one-size-fits-all sort of magic bullet that can deal with this, because, as I said earlier, we have never been in this situation before. And what we're seeing, certainly here in Europe, I ricochet between London and Paris on a fairly regular basis, is that there are already signs, certainly here in France, of an impact on tourism and the industries that are associated with that. So Europe is reacting because, yes, there have been support, for example, by the French government to help motorists offset the cost of higher gasoline and diesel prices. And we'll see similar measures introduced, or we have seen similar measures introduced in other countries. But the wider issue of offsetting the impact of the Strait of Hormuz, that's a big question which will require, if there is to be significant efforts to bypass the strait in the future, that is going to require tens of billions of dollars of investment and infrastructure in pipelines, loading terminals, storage facilities around the Gulf. But what we've already seen in response to the crisis so far, as I come back to this point, that everybody talks about 20 million barrels a day or so of oil coming through the Strait of Hormuz on a daily basis. And that was true before the crisis. But what we've already seen is that countries such as Saudi Arabia and the UAE, which have the ability to divert oil from the normal escape route through the strait across their territory to other loading terminals, they are doing that on a large scale, and they will do more of that in the future to help offset the crisis. But the point about this is, so far, is that yes, we have lost normal flows through the strait, but a range of measures, including higher exports from elsewhere in Saudi Arabia and the UAE, reduced Chinese imports, higher US exports, strategic stock withdrawals, demand destruction, they have offset it, so that so far the net fall in supply is significantly less than the gross number of 20 million barrels a day.
All right.
So maybe the worst is come.
All right. Well, given what Neil just said, David, I'm going to ask you to look into your crystal ball and tell us, what ultimately does that mean? I mean, David, Neil spoke a little bit about the offsetting measures and demand destruction. Is a global recession then an inevitable fate that we're looking at if this drags on? Are we looking at a strong possibility of a global financial crisis? What is on the horizon for the world?
I mean, it's very, very difficult to say. I mean, obviously there are scenarios that you can point to where the Strait of Hormuz stays permanently closed, where oil prices go to some crazy high levels, and then you can get into really nasty scenarios for global growth and global financial stability. I don't think we're there yet. It's worth bearing in mind that monetary policy in the United States, which is crucial in this discussion because it shapes risk appetite globally, monetary policy in the United States is not excessively loose at the moment. And so if there is a rate hike, needed, or maybe more than one, it's not as though the Federal Reserve is starting from an excessively low level. And I think that helps to kind of stabilize the outlook. But of course, if you really want to depress people, you can come up with scenarios that do involve a global recession. But I think we're still far away from that.
Hopefully it stays far away. But Jayati, as we look to how long this is going to last, even if this conflict ends today, what is the global south looking at in terms of potential food crisis, as well as the effects of the energy crisis and effects of rising prices?
Well, that's the issue. I think for the global south, we're looking at least a couple of really, really bad years, possibly stagflationary years, because it's not just, even as you say, if the conflict ends tomorrow, we will still have the impact of unleashing all of these kinds of stopped supplies. Fertilizer prices will remain high. That is already impacting sowing across, this is the sowing region in large parts of Asia and sub-Saharan Africa. And that's going to impact yields over the next year and year and a half, actually. And all of these things really they have a sort of dynamic impact. The declines today in employment that we have seen in so many countries, and the decline in livelihoods, the wages of those who are employed, are again going to have negative multiplier effects over time. So I think dynamically, even if the war stops tomorrow, and if the Strait of Hormuz is opened completely tomorrow, we're looking at a couple of really bad years. I haven't even still mentioned the export constraints and the capital flight. Again, all of this adds to a triple whammy for our countries.
All right, we're going to really have to end it here, but let's thank our guest, Neil Atkinson, visiting fellow at the National Center for Energy Analytics in Washington, D.C., David Lubin, senior research fellow of the Global Economy and Finance Program at Chatham House, and Jayati Ghosh, economist and professor of economics at the University of Massachusetts Amherst. And that's it for our show. But remember, you can get in touch with us on X. Use the hashtag AJCTC when you do, or drop us an email. Countingthecost@aljazeera.net is our address. There's more for you online at aljazeera.com/CTC. That'll take you straight to our page, which has individual reports, links, and entire episodes for you to catch up on. That's it for this edition of Counting the Cost. I'm Sami Zaidan from the whole team here. Thanks for joining us. The news on Al Jazeera is next.